LP2 assignment, financial statement presentation by ChrisEllison. Working for a large public service transportation company, there are many employees and roles within the company that help it carry out its strategic objectives. As accounting clerks and technicians, it may be useful to gain an orientation about how financial statements are used and interpreted within the context of your company. Financial statements are important to a company for many reasons. They give you an indication of a company's performance and value. They're used by other companies or lenders to measure your company. They can also help you manage your company when you're no longer hands-on with all the details. Financial statements of a company are comprised of an income statement, balance sheet, statement or cash flows, and each are interrelated in many ways. It is important to examine all the financial statements in order to obtain a complete picture of its financial situation. Financial ratios are also important for understanding exactly what to do with the financial data and how to interpret it. And we'll learn about this financial information so you can better understand how you may apply it to your business. A balance sheet provides information about a company's assets, liabilities, and the shareholders' equity at a particular point in time. It also provides a foundation for calculating rates of return and evaluating its overall capital structure. To put it simply, it's a financial statement that provides a snapshot of what a company owns and owes, as well as the amount invested by shareholders. An income statement is a financial statement that provides information about a company's performance, which is how business incurs its revenue and expenses throughout both operating and non-operating activities over a period of time. It also shows the net profit or losses incurred over a specific accounting period. Cash flow statements, also known as statements of cash flows, focus on the flow of cash in and out of the business and breaks the analysis down into operating, investing, and financial activities. The cash flow statements capture both the current operating results and the accompanying changes in the balance sheet. The statement of cash flows acts as an analytical tool and is useful in determining the short-term viability of a company and its ability to pay bills. People and groups interested in cash flow statements might include accounting personnel who might need to know whether the organization will be able to cover payroll and other immediate expenses, potential lenders or creditors who may want a clear picture of the company's ability to repay, potential investors who need to judge whether a company is financially sound, potential employees or contractors who need to know whether the company will be able to afford compensation, and shareholders of the business who want to monitor how the business is doing. Financial ratios will help you know exactly what to do with this data and how to interpret it. On its own, a ratio may not be useful, but when compared with other companies in the same economic sector, however, to the broader market or considering changes over time, ratios may be a powerful tool to evaluate how attractive a potential investment might be. There are various ratios you can calculate and many sources you can choose from depending on what you're doing. These ratios come from liquidity measurement ratios, debt ratios, return on equity, operating performance ratios, sales, revenue per overview of debt, cash flow indicator ratios, operating cash flow, sales ratio, profit margin analysis, profitability indicator ratios, and many others. Some may ask the question about which financial statement is most important. I would say it depends on your particular business perspective and interest. If I was a stakeholder, for example, I would be most interested in the income statement to observe dividends. If I were a prospective investor, I'd want I would be most interested in the statement of financial position. Moreover, if I were a creditor or lender, I'd be most interested with the cash flow statement to evaluate liquidity. However, if I were to decide which was the most financial or important financial document, I believe it would be this income statement and a balance sheets are probably the most important because the statement of cash flows can be constructed from these two documents.